Diane, how do you think that the Fed chair will elaborate on the risk that coronavirus presents to the U.S. economy?
I think what he's got to do is what we've all been doing, is lay out the most benign scenario, which is the V-shaped recovery and a quick recouping of the losses and disruptions created by the coronavirus, and then go to other scenarios that the Fed would be prepared to react to if they spilled over into the U.S. economy. What really is hard for the Fed chair is sort of the minute you think you're lifting tensions related and uncertainty related to trade tensions, you have it replaced by the coronavirus and hitting the manufacturing sector the hardest, both through foreign demand and disruptions to the global supply chain. And I think he'll be walking through those different kinds of scenarios for Congress and saying, listen, depending on how they come out, we'll deal with it. What he clearly feels right now is that they've got a bit of a buffer entering this year with the tailwind from the rate cuts they've already done. Whether that stays that way, it remains to be seen.
John, how high do you think the bar is for weaker data as a result of weakness in China and the coronavirus for the Fed to actually make a move, cutting rates or easier policy in some form?
I think that it's definitely in the cards as something it could play if it needed to. But it really depends upon how long it takes to stem the spread of the virus, to come up with some kind of a vaccine and an appropriate and quick regime to take care of those who have the illness. So we think that the way the Fed has operated thus far is the right way to go, and we think the Fed remains highly sensitive to both growth as well as weaknesses in the economy.
Diane, what about the U.S. consumer? I mean, Powell describes the economy as moderate. What's your outlook for the rest of the year and just how resilient the U.S. consumer can stay amid these kind of risks to the downside like coronavirus?
Well, and I think he was very pointed by saying, at least acknowledging the massive slowdown we saw in consumer spending in the fourth quarter, but saying, listen, we think fundamentals are still good. Well, fundamentals are still good in part because we've had good employment gains and because the Fed has cut rates. And he also noted, even though we had this weakness in manufacturing and the consumer didn't actually slowed its pace by half in the fourth quarter in terms of its spending, the fundamentals are still good. Mortgage refinancing has picked up, home buying has picked up. And that all tends to feed into additional gains going forward. Our view is about a 2% growth economy now. That is still solid. That's still above the economy's potential and still downward pressure on the unemployment rate, barring a major disruption due to the coronavirus.
Hey, John, more directly, that monetary policy report did say that asset valuations are elevated. They've risen since July. Investor risk appetite appears to have increased. How much room is there if the lawmaker has the inclination to press Powell on just asset valuations right now?
Well, I think the lawmakers are bound to press Powell on asset class inflation that we've seen. But the reality is that particularly related to equities happens to be related to longer-term disinflationary trends that are fed by two genies that aren't about to go back into the bottle, which are technology and globalization. So we think that what's happening in the market is not the Fed's fault. It's just the reality of a transition that's occurring and the dramatic changes that over the 11 sectors will occur as a result of technology. We think that what we'll likely see is an improvement moving forward in terms of the disparity between wage earners and the upper end of the pay scale. We think that'll change as people start getting trained for the new economy.